Welcome to the Deep Dive. We unpack complex topics and help you find the facts that really matter. You know how in textbooks things often get simplified, like maybe assuming every asset purchase lands neatly on January 1st, perfect for a full year's depreciation calculation, right? Well, today we're going to pull back the curtain a bit on two real world accounting challenges. They make depreciation, well, a lot more dynamic than those tidy examples suggest. Today, we're taking a deep dive into partial year depreciation and also the fascinating, sometimes tricky world of changing estimates in depreciation, our mission, to give you the insights, really, to understand not just the what, but the why and the how, so you grasp the mechanics and the judgment involved. Before we dive deeper, just a quick reminder that this deep dive draws heavily on material from Farhat lectures. All the content, the examples, the explanations we discuss, they come from the comprehensive accounting resources over at farhatlectures.com. So whether you're studying accounting, prepping for the CPA exam, or you're already a professional, definitely visit the website. Lots of practice questions, video lectures, and detailed support there. A special thanks to Professor Farhat for providing this valuable material. Okay, let's unpack this. So we've all seen those straightforward problems, right? Asset bought Jan 1st. Full year usage, full year depreciation. Simple. But I mean, real companies buy assets all the time. Throughout the year, they don't wait for New Year's Day. So how do accountants deal with that? Here's where it gets really interesting.
Exactly. And that's precisely why partial year depreciation isn't just some small detail. It's absolutely essential. Think about it logically. You can only expense depreciation for the time you actually owned and used the asset within that specific year. It would be misleading, wouldn't it, to take 12 months depreciation if you only had the machine running for, say, 3 months. And this usually applies to the first year you buy it and often the last year you sell or retire it too. Because those events rarely line up perfectly with the fiscal year start or end. It really comes down to the matching principle, matching the expense of using the asset to the revenue it helps generate in that period.
That makes perfect sense. Yeah, you can't pretend you use something all year if you bought it in, say, October. The source material gives us a really clear example. Let's run with that. Imagine a company buys a delivery truck. They purchase it on April 1st for $50,000. Estimated useful life, 5 years. And estimated salvage value, $5,000. They're using the straight line method. So how do we even begin to calculate the depreciation for that first partial year?
Okay, the first step, always, is to figure out what the full annual depreciation would be, as if, hypothetically, it was bought on January 1st. That gives us our baseline number. With straight line, that's cost minus salvage value divided by useful life. Pretty straightforward. So, for this truck, $50,000 cost minus $5,000 salvage value. That's a $45,000 depreciable base. Divide that $45,000 by the 5-year life, and you get $9,000 per year. That's the full year amount.
Right, $9,000 for a full year, but they didn't have it for the full year. They got it April 1st. So that's April, May, June, July, August, September, October, November, December, 9 months.
9 months, exactly.
So we need to prorate that $9,000. We take $9,000 and multiply it by, well, 9 divided by 12. And that calculation gives us $6,750 for the first partial year. And the journal entry for that would be debit depreciation expense, $6,150. Credit accumulated depreciation, $6,750.
Correct. And what's really key to grasp here is that this prorating idea, it applies across the board. It doesn't matter if you're using straight line or double declining balance or units of production or any other method. The core principle is the same. You only expense the depreciation for the portion of the year you actually had the asset in service. It keeps the financial statements accurate.
That's a really important point. It's a universal concept, not just for straight line, but thinking practically. Imagine a huge company, maybe an airline with hundreds of planes, or a factory with thousands of machines, buying things constantly, calculating depreciation month by month for every single asset purchase mid-year sounds, well, incredibly tedious. Are there shortcuts, like common practices?
Oh, absolutely. That's a very practical question. You're right. Tracking exact dates for thousands of assets can be a nightmare.
Yeah.
So in practice, many companies adopt simplifying conventions. These are allowed under accounting standards as long as they're applied consistently. Two very common ones are the half-year convention and the full-month convention.
Okay, half year and full month. How do those work?
Well, the half-year convention basically assumes, for calculation purposes, that all assets bought or sold during the year were acquired or disposed of exactly halfway through the year, June 30th or July 1st, effectively. So regardless of whether you bought it in January or December, you take half a year's depreciation in the first year and half in the last year. It drastically simplifies things for large asset pools.
Ah, okay. So it averages out, basically.
Exactly. And the full month convention is maybe a bit more intuitive. It says if you acquire an asset anytime during a month, you take a full month's depreciation for that entire month. So in our truck example, bought April 1st, you get the full 9 months, April through December. But even if it was bought on April 28th, you'd still get the full 9 months under this convention.
Got it. And I assume if you bought it May 2nd, you'd get 8 months then, May through December.
Precisely. It just rounds to the nearest full month you owned it. These conventions save a lot of detailed tracking while still providing a reasonable allocation of depreciation. It's that balance between theory and practical application.
That's a great insight into how things work in the real world, balancing precision with, well, sanity. Okay, so that covers assets bought mid-year. But what about those initial guesses we make? You know, the useful life, the salvage value. Those are estimates, right? What happens when, down the road, reality hits and those estimates don't look quite right anymore?
That's the next big piece, and it's super common. Estimates are, by definition, based on the best information you have at that time. But things change. Technology might leap forward, making your equipment obsolete faster than you thought. Market prices for used assets might plummet, changing the salvage value. Maybe you use the asset way more or way less than planned. Or new regulations could even force retirement earlier. When you get new, solid information suggesting your original estimate is off, you actually have to adjust it. It's part of keeping the financial statements relevant and reliable. The crucial thing, though, is that these changes must be made in good faith. There needs to be a valid, justifiable reason, not just changing numbers to make profits look better or worse.
Okay, so estimates can and should change. But what does that mean for the books? If we change our estimate for the truck's life in year 3, do we, I don't know, go back and redo the depreciation for year 1 and year 2? That sounds incredibly messy, like constantly rewriting history.
Right, and that's a really important question about financial reporting integrity. The answer is a clear no. You absolutely do not go back and change past numbers. The core accounting principle here is that changes in estimates, and this also applies to changes in depreciation methods, are handled prospectively,
Prospectively, okay.
meaning they affect only the current financial period and future periods. You draw a line in the sand. The depreciation you already recorded in year 1 and year 2 stays exactly as it was. Those financial statements were issued based on the best information then. You don't restate them for estimate changes. Think about it. Investors, banks, everyone relied on those past statements. Constantly changing them would destroy credibility and make year-to-year comparisons impossible.
That makes total sense for stability and trust. So the past is the past. But doesn't that create a potential issue for someone trying to analyze trends? Like, if the depreciation expense suddenly jumps or drops because of an estimate change?
That's a sharp point. Yes, it can. The depreciation expense in year 3 might look very different from year 2, not because the asset's usage pattern fundamentally changed overnight, but because the estimate driving the calculation changed. This is why the footnotes to the financial statements are so critical. Companies are required to disclose significant changes in accounting estimates and explain their impact. A good analyst reads those footnotes carefully. They need to understand why the depreciation number changed to make valid comparisons or adjust their own models. It adds a layer of analysis, definitely.
Transparency through footnotes. Got it. Okay, let's bring this back to our delivery truck example to see exactly how this prospective application works.
Perfect. So let's refresh. Original cost $50,000, initial 5-year life, initial $5,000 salvage value. We recorded $6,750 depreciation in year 1, the partial year, and $9,000 in year 2, the first full year. Now, let's say at the beginning of year 3, so after the partial year and the first full year have passed, management reassesses. Maybe the truck's had some hard miles, or maintenance costs are climbing faster than expected. They now estimate it will only last for another 2 years from this point forward. So the remaining useful life is just 2 years.
Okay, so the remaining life is shorter, and they also revise the salvage value estimate downwards from $5,000 to $3,000. Maybe the market for used trucks of this type has softened. So with these new estimates in hand for year 3 onwards, what's the very first thing we need to calculate?
The absolute first step, before you calculate the new depreciation, is to determine the asset's book value at the time the estimate changes, right at the end of year 2, in this case. The book value represents the cost that hasn't been depreciated yet. It's our starting point for the revised calculation.
Right. Book value is cost minus accumulated depreciation. So we need the total accumulated depreciation first. That was $6,750 from year 1 plus $9,000 from year 2. carry the one. That's $15,750 accumulated depreciation.
Exactly, $15,750.
Okay, so the book value at the end of year 2 is the original cost of $50,000 minus that $15,750, which gives us $34,250.
Perfect. $34,250 is our starting point for the remaining depreciation. Think of it as the new amount we need to depreciate over the asset's remaining life.
Got it. So the second step is to calculate the new annual depreciation using this book value, the new salvage value, and the new remaining useful life.
Precisely. It's like a mini depreciation calculation starting now. We take the current book value, $34,250, subtract the new salvage value, $3,000, which gives us the remaining depreciable amount, $31,250. Then we divide that $31,250 by the remaining useful life, which we now estimate to be only 2 years.
Okay, so $31,225 is the new annual depreciation expense. And that $15,625 amount is what the company will record for depreciation expense in year 3 and then again in year 4.
Correct. For the next 2 years, based on the current estimates.
And crucially, going back to the prospective rule, we don't touch the $6,750 from year 1 or the $9,000 from year 2. Those figures stand. We just use the new $15,625 figure going forward.
Exactly right. That's prospective application in action. You adapt based on new information, but only for the present and future. And, the source material reinforces this very clearly. It basically asks for the best description of revising an estimate. And the answer highlights that it's reflected in the current and future years, not in prior statements. It really drives home that changing estimates is normal, it's part of accounting judgment, and it's handled looking forward. And this isn't just academic. These changes directly impact reported profit asset values on the balance sheet. That affects everything from stock prices to loan agreements to maybe even manager bonuses tied to profit. So getting the estimates reasonable and accounting for changes properly has real consequences.
That's a great way to tie it all together. Okay, so let's quickly recap the big takeaways from today's deep dive. First, partial year depreciation is essential because, well, assets aren't always bought on January 1st. We need to prorate the expense to match the actual usage period, although conventions like half year can simplify this. And second, when accounting estimates like useful life or salvage value change, which happens, we apply those changes prospectively, meaning only to the current and future years, preserving the integrity of past reports.
And why should you care about these seemingly technical details? Because understanding them gives you a much more realistic picture of what's going on in financial reports. It shows that accounting isn't just mechanical. It involves significant judgment, adaptation, responding to new information. It's not just about rules. It's about applying those rules thoughtfully. It encourages you, hopefully, to look at financial statements a bit more critically and think about the estimates baked into those numbers.
Absolutely. And here's a thought to leave you with. Think about today's world. Technology changes so fast. How does that impact useful life or salvage value for things like, say, AI computing hardware, or maybe specialized equipment for renewable energy? Can you think of examples where companies might be constantly adjusting depreciation estimates just to keep up with the pace of change? It's a really dynamic part of modern accounting. And if you want to dig even deeper into depreciation or any other accounting topic, remember to check out farhatlectures.com. There are tons of resources, practice questions, videos, really valuable stuff to keep learning. It's always a good investment. Investing in yourself. Until next time, keep learning, keep asking questions, and keep diving deep.